Good morning, Jesse. How are you this morning?
Good morning, Leslie. Doing really good.
All right. So today, all right, everybody. Today we're speaking with Jesse Mitchell from Gold Financial. He's going to talk to us about FHA and conventional loans and why one may be better than the other depending upon your situation. All right, Jesse. So let's start with you. Tell me, you're in mortgage. How long you been in mortgage? Why you're in mortgage? What you love about it?
Okay, I've been in mortgage for over 10 years. What I love about it, of course, is helping people, and I genuinely do like that. I love the ability to help people move from one point to the other to see what their options are, and hopefully, and finally, to get into homes. I got into it myself because there were people who kept telling me that I should get a home back when I was living in an apartment. And for the longest time, I didn't because I wasn't ready. But once I was, and once I found out what my options were, that helped move me into that position to go ahead and become a homeowner and take care of all the joys of home ownership. You know, the lawn, house upkeep, and of course, being able to invite people over in the backyard. Can't miss out on that.
Exactly. All right. So today, let's talk about the FHA and conventional. Let's start with FHA. I personally like FHAs, and most of my first-time home buyers usually start with FHA.
Mhm.
Tell me why that is.
Okay, so if someone has an FHA loan, the FHA loan has the lower down payment. So there's a 3.5% down payment. And that's 3.5% of the sales price. FHA is also a little bit more, I'm going to use the word forgiving on credit. So if somebody's had a couple of bumps in the road on their credit, some late payments here or there, maybe something's kind of happened in the past, FHA is still more likely to approve in those situations. The view of that is that it's not as conservative as, say, some other programs. The other thing is you have your low down payment, you have the ability to get the loan, and then your debt to income percentage is higher for FHA. So when you go into a loan situation, your debt is going to be looked at. Your debt is going to be all payments that show on your credit report that you currently have for debts that you have, and your new mortgage payment. All of that is going to be added up, and that is your debt. That is going to be placed over your income, whatever the income is for the household or for the people on the application, and your debt to income is going to yield a percentage. FHA allows up to 57% of debt to income, whereas some other programs may want you to have lower than that amount. So it also, helps people in that regard. So if you're in a situation where maybe you have a higher debt situation, but you can afford to make a mortgage payment, FHA may be the way to go for you. The last thing that I would note is that, and it changes every so often, but for the most part, when it comes to interest rates, sometimes your interest rate may be a little bit better with an FHA. FHA may allow you a half a point or more better
Mhm.
interest rate if you're going with FHA as opposed to another program.
Right. I honestly, usually the reason my clients are going FHA is for the low down payment, and maybe you're right. There may be some credit bumps that they've had that that can do with that. So now let's talk about conventional and what are the pros and cons of conventional?
Or a conventional loan. So with the conventional loan, you are going to be looking at a situation in which, and I'll just say this outright, I have a realtor on the line with me here. In some cases, and let me first of all say this, FHA conventional, they're both good loans. There's
Right.
nothing wrong with either one. It depends on which one you may qualify for. And once you have it, of course, we're going over the benefits and right now opportunities. So the biggest thing that you may run into as a home buyer is that the seller of the home that you're interested in may specifically ask for a conventional loan.
Very
So if
true.
they're only looking for a conventional loan, then that's the type of loan that you have to have in order to get into that home. One of the biggest benefits of a conventional loan, if somebody is willing to, or and able to, for that matter, put down a higher down payment. Let's say the conventional down payment, minimum down payment is 5%. If you're able to put down 20% or more for your down payment, you will avoid what is called mortgage insurance.
Right.
Both FHA and conventional have mortgage insurance, not to be confused with your home insurance.
Right.
Home insurance is something that you would use in the event that there was a hailstorm and you had hail damage. If there was some sort of structural issue with the home and you needed it fixed to that effect, this is where you would call your home insurance. Mortgage insurance is for the mortgager or the investor, or shall I say the investor or the banker that's giving you the money to buy the home. That insurance is paid in the event that, as you own the home, if something happens and you're unable to complete the payments on that home, it is an insurance that backs them to make sure that they get their money back on their investment.
Right.
Now, some people may be like, well, why do they need that? Please keep in mind, prior to mortgage insurance existing, people had to bring to the table 20% or more in
Right.
order to get a home. Nobody would, make a loan for them if they weren't putting a significant amount down. So sometime after the Great Depression, it was established that there would be a mortgage insurance as part of the factors to allow people to have affordable home opportunities and to pay a lower down payment percentage, such as the 3.5 or the 5%. Now, the conventional loan, if you put down 20% or more, you don't have mortgage insurance in your payments. So the mortgage insurance will show in your monthly payment. You have your principal and interest amount, which usually will not change. You have your taxes and your insurance, which is usually your escrow, and then you have your mortgage insurance. All of these are components of your mortgage payment. In a conventional loan, if you put down 20% or more, you don't have the mortgage insurance component. So you may be able to save 100, 150, or whatever the mortgage insurance is. Now, with a conventional loan, if you put down the minimum 5% or anything below 20%, you're going to have the mortgage insurance on the loan until you reach less than 80% of the loan amount, the loan to value amount. Once you reach that mark, that mortgage insurance comes off of the conventional loan. So with a conventional loan, at some point in time or another, you either don't have the mortgage insurance or you at least have the opportunity where eventually it will come off of your loan payments. Note the difference. With the FHA loan, you're going to have mortgage insurance. With the FHA loan, even if you put a higher amount down, you're going to have the mortgage insurance.
Right.
More than likely, you're going to have it for the lifetime of the loan. Even if you put down a higher down payment, it may come off, but it'll still be years before it comes off compared to the conventional.
When my clients get an FHA, actually, when they get FHA or conventional loan, where there's mortgage insurance involved, every year I go back. Well, I do this for every client, whether or not the home loans in existence or not. Every year I go and I do a competitive market analysis on the property, because sometimes if the property value is increasing, you may not be paying it down to get to where you have that 80-20 ratio to remove mortgage insurance, but the property value may have increased. And that may be the time to go back to your bank and say, hey, or with FHA, refinance, get a conventional.
Yes.
Refinance, get that conventional loan.
Thank you for bringing that up. That's an opportunity. So please keep in mind, if you are between the two, FHA, conventional, it's going to come down to the lender and what your choices are.
Right.
The other thing that's going to have a big impact on whether you can get an FHA loan or a conventional loan is your credit score. You have to have a higher credit score than to get a conventional loan as opposed to an FHA loan. So that also helps people. The difference sometimes can be roughly around 40. I'll give an example. If you have roughly, say, a 620 or above, I'm sorry, let me take that from the opposite way. For a conventional loan, you may need to have a 640 or above in order to get a conventional loan, meaning your middle score, the score driving your decisions, needs to be 640 or above. If your score is under 640, you won't even qualify for a conventional loan. Your only option at that point would be an FHA loan. For whatever reason that you start, if you begin your house ownership with an FHA loan, much as Leslie's pointed out there, once you're in the home for, say, a year or two and you look at your situation, if things have improved, your score has improved, your financial situation's improved, you can look at doing a refi and take your loan from an FHA to a conventional loan. Again, once you're in the conventional territory, you're now in that position where the mortgage insurance can come off of the loan at some point in time.
Right.
So starting with FHA isn't bad.
Yeah. So I always tell my buyers they need to start their mortgage process 6 months before they even start their house hunt. And here's why. Because mortgage professionals like yourself, they can tell you what you qualify for right now. But you can also tell them, if you did this, you would get a better interest rate. If you did this, you could go from FHA to conventional. And should I ask them to take more time, jump ahead more time, say more than 6 months, or do you think 6 months is a good amount of time for them to work on their credit if they need to?
6 months is fine. It depends on what's needed. The earlier, the better. I always tell
Right.
people this. And to piggyback on your point, what you don't want to do if you're looking to buy a home, if you know that you want to buy a home in March, please do not wait and apply in March.
Right.
Don't, and if you can, try not to apply in February. So to Leslie's point, you want to start as early as possible. Reason for that is if you do have some issues that we need to address, maybe they're credit issues and we need to work on getting your score up. I have a credit tool where I can help people with that. So if you don't qualify today when you do your application, we can go over it. I can make some suggestions to you. If you're able to follow those suggestions, your score may increase within 30 to 45 days at the earliest. If not, and if we need a little time, then that's what that time will allow for. So again, if you're looking to get a house in March and we're looking at your application in February, now you may not really begin to be able to look for a house till the end of March or beginning of April. So it's pushed your timeline out. But had we started, say, to Leslie's point, in October, we already know what you need. We can already put those suggestions in place. You can implement those actions. And by December, we already know that you're sitting in the position that you want to be in to get the house that you want to have. So we always want to take advantage of the time. Now, as far as your pre-approval, keep in mind, if we are able to get you pre-approved, say October, December, that means that you're ready for February, March when you're ready. So that's another good thing. You don't even have a headache about your financing. You know that's taken care of. Now all you have to do is find the house. From a lending aspect, if enough time has passed, all we need to do is update some of your documents, pay stubs, things of that nature, and keep going as long as there's not been any major changes.
Well, I'm really hard on my buyers when it comes to that. Like I want them to go full head, I want you to buy that house, but I really want you to plan this out. I call it getting your ducks in a row. And when you're in a tight seller's market, which we are right now, when you bring an offer to my seller, I look at that. I don't just say, "Oh, look, they're pre-approved for that much." No. I read every word of that document, find out, has that lender looked at their docs? Has that lender verified their income? So that pre-approval letter, when I have 2 offers in front of me, which right now these days we often have multiple offers in front of us, I am looking at every little detail on it. So having your ducks in a row makes a huge difference. And listen, if I got 2 conventional loans in front of me, both of them putting 20% down and both of them pre-approved, and one of them hasn't verified the verified income, I'm going with the one. I'm telling my seller to go with one that's verified the income. I'm going with one who's completely ready to go.
Yep.
All we need is a house and underwriting.
That's
So
it.
it makes a huge difference when you do that. So, and what other tips do you have for someone who's thinking about buying their next home?
What we've covered today is very important. Using time to your advantage, making sure that you've got the application piece taken care of, that all your, as Leslie said, all your ducks are already in a row. If you are looking to get more home than what you originally qualified for, again, going back to the advantage of time, let's have that conversation. Let's see what you need to do and what needs to be in place to get you where you're going. If you are ready to make the move and you're ready to move forward and you feel like, hey, I got everything in place, I can make a payment, I just don't have enough money saved up. Let's look at that. Let's see if there are any opportunities out there to get resources to help you with your down payment. That may be possible. Other than that, I would just say, honestly, come in with your information. Come in, let us know. Communication is key.
Absolutely.
Let us know what you're looking for. Let us know what your non-negotiables are, and be open to the information we give you. We are not going to make decisions for you, but we're going to give you the information and educate you. And we're going to step back and let you make the decisions that are best for you in this course of action that you're taking.
Now, Jesse, if someone wanted to get in contact with you and find out if they can get pre-qualified, who do they call? Who do they email? Who do they text?
Gotcha. You can give me a call at 817-228-3021. Again, that is 817-228-3021. You may also go on my website, which is Lorenza, kind of like Lorenzo, but it ends with an A instead of an O. LorenzaLending.com is my website. And you can email me at jmitchell at goldfinancial.com. And that's
And
jmitchell@goldfinancial.com. Go ahead.
and Jesse, although you gave an 817 area code, which is North Texas,
Mhm.
you're licensed to provide loans all over Texas, aren't you?
Correct. My office is actually in Cedar Hill, and I can help anybody anywhere in Texas.
Yeah, we know. I mean, you and I probably have known for a long time. During COVID, we've all learned to make adjustments for ourselves, but there are oftentimes we don't, necessarily see a lot of our clients. I mean, I see them if they're buying a home or selling a home. Well, actually, I have several that have bought a home without seeing me. They bought the home sight unseen, doing video.
Realtor unseen.
We do well. They see me, but it's usually because I'm doing a virtual tour for them, and they're not in the country. But they don't have to be in the same city with
Correct.
you to get things done, and they can do things like a Zoom meeting, phone calls, and things like that, right?
That is correct. In the nature of the process, even pre-COVID, my part of my role in the lending process, in the house buying process, I honestly don't see many of my customers. Most of it is over the phone,
Right.
online, and everything is handled that way. And in the process, of course, even once we get to the last part of the process, which is closing, I am not required to be at the closing. I don't have to be there, nor am I required to be there. But I usually have always made it a point to go to my closings. One, most importantly, for the simple fact that it's the only time that I get to meet the people in person that
Right.
I've worked with for 30 days or more. And again, with COVID having happened, I haven't had a chance to do that frequently. I still do it whenever I get the opportunity, but I also want to be respectful if we are doing, say, a mobile closing or limited closing with closing with limited people, then I'm not going to insert myself in that position because there's a reason why we're doing limited people. And if people need to speak to me during the process, as Leslie's pointed out, we can do an online if we need to, or if you are in the area, we can meet at my office in Cedar Hill or find a meeting place if it works for us to actually meet up if we need to.
All right, Jesse, you've educated us, and hopefully a few people will give you a call that realize it's not as scary and as difficult as they may have thought. But now they know they need to get their ducks in a row. They can't wait until the last minute.
That is correct. And the more information you have, the better. The more you know, the less frightening it seems, the more comfortable you become, and the better you're going to be at making decisions that you're going to need to make, because throughout this process, you will be making some decisions.
I always tell my clients, I know it's scary, but it's going to be more scary that it's easier than you thought. It really is.
Correct.
All right. Thank you, Jesse. We'll be talking again.
Very much, Leslie. Thank you.
Bye.